Let's get straight to it. European markets just took a major hit, and the shockwaves are being felt in every corner of the continent. Investors, traders, and analysts are all scrambling to make sense of what just happened, as the numbers on the screens keep tumbling lower. At the heart of this turmoil is artificial intelligence. AI is at the center of the storm, and its impact is impossible to ignore. What was once the hottest ticket in town is now the source of sleepless nights for many. The tech-fueled party is over. Investors are suddenly questioning if the AI boom was all hype. The optimism that once drove markets to dizzying heights has evaporated almost overnight. For months, any company whispering AI saw its stock soar. It didn't matter if the business had a real plan or just a buzzword. Investors piled in, hoping to catch the next big thing. But now, the market wants proof. Real profits, real growth, and real innovation. Hype alone isn't enough anymore. The mood has flipped from euphoria to fear. The same investors who were celebrating just weeks ago are now gripped by anxiety, watching their gains evaporate. The sell-off isn't a blip. It's a trend, and it's spreading fast. Panic selling is replacing the buying frenzy, and the downward momentum is feeding on itself. Wall Street's tech retreat is spooking Europe. When American tech giants stumble, the ripple effects are immediate and severe for European markets. When the US giants fall, everyone else gets nervous. The interconnectedness of global finance means no one is truly insulated from the shock. Investors are no longer asking, how high can it go? But, how far can it fall? The conversation has shifted from dreams of endless growth to fears of catastrophic losses. The fear of missing out has turned into the fear of being left holding the bag. No one wants to be the last one out when the music stops. Valuations look detached from reality, and the bubble talk is everywhere. Pundits and experts are debating whether this is just a correction or the start of something much bigger. This is a fundamental shift in sentiment, a sea change you can't ignore. The optimism that once fueled the AI rally has been replaced by deep skepticism. The easy money is gone. The days of quick wins and effortless gains are over, at least for now. Now comes the hard part, figuring out which AI bets are real and which are just smoke and mirrors. Investors are digging deeper, demanding transparency and accountability. The market is demanding receipts, not dreams. Only those companies with solid fundamentals and proven results will survive this storm. If you're not careful, this tide could pull your portfolio out to sea. The risks are real, and the consequences could be severe for those who aren't prepared. The question now, who will sink and who will swim? In this new environment, only the strongest and most resilient will make it through. The AI wave that lifted Europe is now threatening to drown it. The coming weeks will reveal who can adapt and who will be swept away by the storm. Let's look at the numbers, because they tell the story. The Stoxx 600, Europe's broadest index, dropped 0.6%. Not a crash, but a steady, unnerving slide. London's FTSE 100 and Germany's DAX both fell, with the DAX down nearly 0.8%. France and Italy weren't spared either. Billions in value vanished from portfolios across the continent. This wasn't about one company or country. It was a synchronized retreat. Investors are fleeing risk, and the red ink is everywhere. The party's over, and the hangover is real. These numbers are a scoreboard. Right now, fear is winning. This isn't a local crisis, it's global. The sell-off started in the US, hit Asia, and then slammed into Europe. When Wall Street sneezes, Frankfurt and Tokyo catch a cold. Tech giants like Nvidia and AMD tumbled, sending shockwaves worldwide. In Asia, Japan's Nikkei plunged over 2%, with SoftBank dropping 8%, a sign big money is running scared. For 18 months, investors chased the AI dream. Now reality is setting in everywhere. The fear is contagious, and everyone's asking, are these AI stocks really worth it? This is a global reckoning, not just a European one. The AI rally was fragile. Now, the cracks are showing. No market is immune when the story changes this fast. Let's call it a bubble. A bubble forms when asset prices inflate far beyond their intrinsic value, driven by exuberant market behavior and speculative investments. For 2 years, AI stocks soared on hype, not profits. The promise of revolutionary technology drove prices to unprecedented heights. Investors bought dreams, not earnings. They were captivated by the potential of AI, often ignoring the lack of immediate financial returns. Now, the market wants cash flow, not promises. The shift from speculative enthusiasm to financial pragmatism is stark. The gap between AI's potential and today's reality is huge. While the technology holds promise, its current applications are limited and not yet profitable. Valuations are based on profits that might not arrive for years. Investors are betting on a future that is still uncertain and fraught with risks. The sell-off is the market's way of saying, "Show me the money, now." Patience is wearing thin, as investors demand tangible returns. FOMO drove prices up. Now, fear is driving them down even faster. The emotional roller coaster of the market is in full swing. The feedback loop has reversed. Everyone's running for the exit. Panic selling is creating a downward spiral. All the classic bubble signs are here: parabolic prices, wild media hype, and a sudden, sharp correction. The hallmarks of a bubble are unmistakable. The first pin has pricked the bubble. The initial shock has set off a chain reaction. Is this a healthy correction, or the start of a bigger crash? Analysts are divided, and uncertainty looms large. The market is fragile. One more shock could pop it for good. The stability of the financial system is at risk. The hangover from this AI party could be brutal. The consequences of the bubble bursting will be felt for a long time. Investors are waking up to the risks they ignored. The reality check is harsh but necessary. The question isn't if we're in a bubble, it's how much air is left. The reckoning has begun, and the market is bracing for impact. Want proof the AI hype is over? Just take a look at what happened to Rightmove, the UK's leading real estate portal. In a single day, the company's stock price plummeted, sending shockwaves through the market and leaving investors stunned. Rightmove had just announced ambitious plans to invest heavily in artificial intelligence, hoping to transform its business and stay ahead of the competition. But instead of applause, the market responded with a brutal 12.5% crash in the company's share price, wiping out millions in value almost instantly. Just 6 months ago, news like this would have sent shares soaring. Back then, any mention of AI was enough to excite investors and drive up valuations, as companies raced to join the AI gold rush. But times have changed. Now, investors are wary. They see rising costs and uncertain returns, not just innovation and promise. The mood has shifted from optimism to skepticism. The market punished Rightmove for prioritizing future gains over current profits, sending a clear signal to other companies. The era of easy money for AI dreams is over. The message is loud and clear. AI spending must deliver real, tangible results, and it has to happen fast. Investors are no longer content with vague promises or distant potential. The AI halo is gone. The market's patience has run out, and the days of giving companies a free pass just for saying AI are behind us. Now, companies can't just sprinkle AI into their announcements and expect investors to cheer. They have to prove that their investments will pay off or risk losing credibility and value. Analysts are spooked, and every CEO is rethinking their AI budget. The pressure is on to justify every pound spent and to show measurable progress, not just potential. Rightmove's collapse is a warning to the entire market. Vague promises and hype won't cut it anymore. Investors want to see real-world impact, not just hopeful projections. The market wants proof, not just potential. Results matter more than ever, and only those who can deliver will survive this new reality. The era of blank checks for AI is over. Investors are demanding accountability, transparency, and above all, results. Every company is now on notice. Show results or pay the price. The stakes have never been higher for those betting big on AI. Rightmove's fall will be studied in business schools as a turning point, a lesson in how quickly market sentiment can change, and how important it is to back up bold claims with real outcomes. The blind faith in AI is dead. Reality rules now. Only those who can prove their worth will thrive in this new era of accountability. Even in a sell-off, there are surprises. ITV, the British TV company, soared 16.6% on news of a possible sale to Comcast. While tech stocks tanked, ITV's old-school deal-making paid off. Its proof company-specific moves can beat the market's gloom. Meanwhile, Novo Nordisk, Europe's pharma giant, dropped 5% after cutting growth forecasts and agreeing to lower drug prices. Billions in value wiped out. Bad news for investors. And then there's Tesla. Elon Musk secured a $1 trillion pay package with 75% shareholder approval. It's a polarizing move. Some see vision, others see excess. The contrast is stark. Some companies are punished for spending, others are rewarded for bold bets. The lesson? Fundamentals and strategy still matter. Even in chaos, there are winners, if you know where to look. The market is wild, but opportunity hasn't disappeared. This week proved, not all stocks are created equal. Central banks are in the spotlight. The Bank of England signaled rate cuts are coming, but markets didn't rally. Why? Fear of an AI bubble and economic slowdown outweighs the lure of cheaper money. Rate cuts, once a reason to cheer, now look like a warning sign. Investors worry central banks are reacting to trouble, not victory over inflation. Lower rates should boost stocks, but recession fears are stronger. Both the Bank of England and Norway's central bank are holding steady, waiting for clarity. The result? More uncertainty, more anxiety. Investors hate not knowing what's next. Right now, the path forward is anything but clear. To understand the market's nerves, look at the economic data. This week brought mixed signals. German trade is weak, but UK house prices rose. Even good news is met with suspicion. A strong housing market could delay rate cuts. Investors are caught in a lose-lose scenario. Good news keeps rates high, bad news signals recession. The market is desperate for clarity, but the data is confusing. When the future is foggy, fear takes over. Investors are selling first, asking questions later. The economic picture is messy, and that's fueling the panic. The market is forward-looking, but right now, the road ahead is a blur. No comfort in the numbers, just more reasons to worry. Until the data clears up, expect more volatility. So, what should you do now? Stay disciplined. The days of easy AI money are over. It's a stock picker's market. Don't panic sell, but do review your portfolio. Volatility is normal. Stick to your long-term plan. If you own solid, profitable companies, you can weather the storm. If you're overloaded with speculative tech, it's time to rethink. Diversification is your best defense. Don't bet everything on AI. Look for opportunities in other sectors. Not all stocks are sinking. Moments of fear can create bargains for patient investors. Do your homework, build a watch list, and be ready to act. In chaos, discipline and strategy win.